Accounting for NCA. Distinction between N treatment of capital and revenue incomes and expenditures. Capital expenditure, money spent on acquiring NCA, expenditure on NCA with an expected life of more than 12 months. Revenue expenditure, the day-to-day expenditure incurred in the day-to-day running of a business. Capital income, money earned from the sale of NCA. Revenue income, the day-to-day income earned from the sale of inventories / the provision of a service. Purpose of accounting for depreciation and the application of relevant accounting concepts in respect of NCA. Depreciation, the apportioning of the cost of a NCA over its useful economic life, the systematic allocation of the depreciable amount of an asset over its useful life. The total cost of a NCA is never charged to the IS for the year in which it was purchased. The cost is spread all over the years that it is used in order to reflect the IS cost of using the asset in that particular financial year. Matching concept, the cost of using NCA to earn revenue should be matched in the IS to the revenue earned in the same period. Prudence concept, if the cost of using NCA was not included in the IS, profit would be overstated, and so with NCAs in the SOFP. Consistency concept, same depreciation method should be used in future years once adopted to allow valid comparisons.